Today I want to play for you one interview being done with Grant Williams, macroeconomist from the UK. Following that, I'm going to give you a number of charts showing what's going on economically in the US. I'm Ben Reppond. Welcome to my YouTube broadcast. Today is May 13th, 2025. So this interview is with Grant Williams. He is a macroeconomist from the UK, and he gives his view. And he believes that there is uncertainty in the market, and that is driving the markets. Of course, that is coming from tariffs being imposed, or the fear of them being imposed or removed, etc. So it's causing the markets at this point to go up and down, up and down. No major decisions are being made right now. We did have over the weekend a settlement between the U.S. and China regarding the tariffs being imposed on China, and then China reciprocated. Their tariffs came down from 115% down to 10%. Ours came down from 145% down to 30%. And so now we're ending up with, at least for 90 days, so we're ending up with a 10% and a 30% tariff. And the market is viewing that very favorably. Again, we've come down, we've neutralized, and now we're going back up. I don't know if it's going to keep on going up, but at this point, the view in the market is positive. Grant Williams talks about NATO and Trump campaigned on this in his 2016 campaign and 2024 campaign, talked a lot about getting the NATO nations to pay their fair share. And the European nations are, they're pushing back on that. That's not going very well. So I don't know where that's going to end up. But again, maybe it's a negotiating point. But right now, the biggest news is U.S. and China. So we'll play this clip for you, of Grant Williams. Take a listen.
Let's start where we always start, because it's been about 6 months since we've had you on. I can't believe it. Time is flying. So let's start with a big picture macro view. I want to know how you're looking at the world today. And as you know, Grant, you can take all the time you need to set the table when it comes to that big picture.
I am looking at the world today from behind my couch and through my fingers. That's how I'm looking at the world like this. It's just like every day is head in your hands trying to figure out what the hell's going on. It's kind of crazy, and that for any of us that are looking at markets or committing capital or, God forbid, managing other people's money, that's a really, really tricky environment to be in because of the uncertainty. Markets hate uncertainty, and even though we've seen kind of this shakiness in markets, and we've seen an incredible retracement back up over the last 9 days, and today is looking like it's pretty unchanged at the moment. That kind of volatility, that kind of uncertainty is really bad for markets long term. And until we get any kind of clarity around how we're going to get the general volatility lower, you're going to see that nervousness in markets. But perhaps more importantly for me is the uncertainty as far as the business community is concerned, and that takes a while to feed into the stock market. But given all the stuff post-Liberation Day, all the tariff uncertainty, the constantly shifting numbers, the constantly shifting allies and enemies, it's impossible for CEOs to think about CapEx at this particular point. It's impossible to really think about hiring. It's impossible to think about doing anything that is required to run a business effectively, assuming it's not a wholly domestic business. And even then, it's very difficult to find a business that doesn't have some kind of connection to overseas imports or parts or anything. So it's a really difficult time to be in business, and we haven't seen that feed through the stock market yet. I had a dinner in London a couple of weeks ago, and what I was hearing around the table from people who have businesses startup businesses that rely on technology but have import components was shocking. I mean, it really was shocking in terms of how big a problem this was for them, and the drastic nature of the plans that they were being forced to put into action to kind of mitigate this. And also at the table was a gentleman who'd been in Germany, and he'd been at an event with a person. I don't want to disclose names because it's not my place to do that, but someone who will have some kind of influence within the Trump administration. And it was an open session, an open conversation with a whole group of German businessmen. Now, Germany's got problems of its own, that's fair enough, but the phrase he used was that there was white heat in the room from the Germans in terms of the disruption that Trump's tariffs were causing. And, the pushback from this gentleman was interesting. This guy said, look, you have free university tuition over here. You have free universal health care. Maybe some of that stuff ought to go to your defense budget, and things have changed. And you have to say, as far as NATO is concerned, the points Trump makes about that are fair. And he was making those points before he came to power in his first term, and he was laughed out the room by a lot of people when he said that NATO was going to have to pay for itself. So all of these decisions by Trump, they feed through to the business community, and businesses are ultimately what are manifested and represented by the stock market. It used to be that we talked about companies and businesses, and I kind of get on this hobby horse of mine every now and again, and now we talk about stocks. That's just a shift in mindset where the price of the shares is way more important to most people than the quality of the business itself and the quality of the company. That, I suspect, is going to have to change, because without the quality of the company, the share prices have no real business performing well, except multiple expansion, except FOMO, all these things that have driven stock prices higher without necessarily improving business. And I think the focus is going to return squarely to businesses, not among the retail investment crowd at the moment, as we've seen in the data. Retail is still in that FOMO move. We saw record inflows from retail into the markets after the big dip. So we're in this kind of air pocket, to me, where the effects of the tariffs haven't been reflected on a company level yet, but I think that could start happening quickly. And some of the anecdotal data you're seeing about port occupancy and trucking numbers, and we're starting to see that in the data that you have to kind of look reasonably hard to find. And there is a lag, but I don't think it's a particularly long lag. So, I would think that in the next couple of weeks, unless things change, and the anecdotal evidence I heard at dinner the other week bear that out, you are going to start to see the kind of knock-on effects, the ramifications of the tariff uncertainty feed through into company downgrades, into scarcity on shelves, into all the things that, once they manifest, make it really difficult to simply ignore that and just buy stocks anyway because of the number and hoping the price goes up. So that's kind of where I think we are in this air pocket, and which way it resolves itself is yet to be seen. And Trump, I'm sure, will flip-flop multiple directions between now and then. But I think the grenade has been thrown into the plumbing, and we're just waiting for it to explode and see where the damage is done. And I suspect in the next couple of weeks, we are going to start to see that manifest.
Okay, now I want to share some economic news with you. The shipping activity, do you remember this during COVID when I think I know I played a clip, or maybe one or two sessions on this, where I showed a picture of all the ships out in the harbor in the bay waiting to get into Long Beach and to LA. I think what I remember was 200 ships waiting to get in. They were queued up, and it was, logjam. And now it's the opposite. So now there is a 35% reduction in ships coming in. This is example is LA, but I think it's true in Long Beach as well, and perhaps Seattle, Portland, and other ports. And so what's happening is, after the initial rush to buy products, now people have backed off, and tariffs are coming in, and the ports, they're not empty, they're just down. And so this is a picture of that. And where's it going to settle out? We don't know, do we? This shows you some data. This is the Port of Los Angeles going back to, this is just a, 7 or 8 week period of time. You can see where it came from, how many containers came all the way down in the last couple of months. It's dramatic. Now I want to go into some data. The labor data is non-farm, so it's everything except farm. Labor productivity, this is not hires, this is productivity, has gone down. Why has it gone down? I don't know. But it was expected to go down 0.8%. So the red bar at the far right is an illustration of where it was expected to go, and it actually did that. So that when you look at over the last 8 or 10 years, that's a low number. And so productivity is down. Labor costs are up. Productivity down, labor cost up, measured by the red bar. And it was up higher than was expected. Consumer sentiment, the expectations of income, I should say. So you can see, this is a survey, so you can see that the expectations are negative. People expect their income to go down at this point. You can see that measured by the line going down at the far right. If you measured it from a real standpoint, adjusting for inflation, that would be much lower. The dollar is declining. It's been declining for the last few months, and it was going up and up and up, and then probably since January, it's been going down. At the beginning at the end of the black line to the far right, that's today. And I drew a black arrow. Then it is expected to go down further, represented by the brown line after the black line. So what that means is that our dollar will not go as far in buying foreign goods, and foreign currency will go further when buying American goods. And finally, I want to show you the Buffett indicator. And some of you know what that is. This is corporate equities, and you could say the stock market, but I'll just say corporate equities divided by gross domestic product, the output, the economic output of our country. So price of stock divided by the economy. How's that? And that is tracked, and you can see this is tracked on a monthly basis. So it is now up to not quite at an all-time high. So corporate equity prices are high, especially relative to the economy. So where's the risk and where's the reward? The reward on the upside, in my opinion, is not as high as the risk on the downside. Thank you for watching. If you have a question or a comment, feel free to leave them in the comment section below. And if you're not subscribed, please subscribe. Thank you.